So I was actually talking to a guy earlier today, and he says, I'm really interested in creative financing, and can you tell me more about what that is? And we're like, first of all, what is your basis of understanding of creative financing? And his response was, well, the bank and hard money. And kind of like, okay, so is there anything else? So you have your perception of what creative financing is, and so bank and hard money, those are two parts of a solution.
Yeah.
But there are dozens of other ways to be able to structure a deal.
And those two aren't very creative.
And those aren't very creative, right? So you have the bank that takes a long process to get there, and they're both two different approaches.
Yep.
And so then, diving into it, when we talk about creative financing, and we're going to address two topics today, subject to and seller carry. And I think to differentiate the two, typically a subject to is to help somebody that can't make their mortgage payment bring that current or take over those payments and help make sure that those payments are being made to secure the house and take care of it to where it's not going into foreclosure, it's not going to be lost, there isn't going to be equity lost. Now you have a transaction that says, I'm taking this note subject to. And we have two other episodes that talk specifically about subject to, but that transaction right there is a vehicle to not have to go and secure hard money lending or bank financing or private money or a seller carry doesn't necessarily make sense because there's funding that's already in place.
Yeah.
And
especially right now with interest rates as high as they are, some of those places you can get into subject to or owner financing have a 2 to 3% interest rate, which is awesome.
Yeah, I just took over one at 2.875.
That's awesome.
Okay. So we've talked subject to, now we're going to talk seller carry. Seller carry or owner financing is you're basically going to an owner of a property. They don't owe any money on the property typically. Or they owe a very small amount. What you're doing is facilitating a transaction where it isn't in distress. They don't have to sell the property, but they may have different priorities or goals or wants and desires. And it may be that they just want to relocate to Arizona and not be in cold Idaho in the middle of winter while it's snowing and blowing and a couple inches down on the ground.
And they may need some cash up front and then a little bit of cash flow to live off of, which you could help solve both problems there. Mm-hmm. Yeah.
But they don't need all of it up front. And so let's say it's a $200,000 property. You can come in and say, I will give you $200,000, but I'll also spread that over a period of time so that you're taxed on $20,000 of that every single year. And part of that is going to be interest. So instead of you getting $200,000, I'll pay you $300,000 over 10 years.
There you go.